Welcome to the Deep Dive. Today, we're really getting into the weeds on Halliburton's second quarter 2025 earnings call.
Yeah, that's right.
Our job here is to pull out the key stuff, the surprising bits, the strategic moves that actually matter, basically giving you the essential download from what their leadership team had to say.
Precisely. And it's more than just the P&L, isn't it? It's about reading between the lines, understanding the currents, shaping their decisions, how they're navigating what's clearly a changing market.
Definitely.
And what that might signal for them and, frankly, the whole oilfield services space.
Okay, so let's kick things off with the headline numbers for Q2. What did they actually report? How'd it look?
Sure. So for Q2, Halliburton posted total revenue of $5.5 billion. That's up 2% sequentially from Q1.
Okay.
Net income per share, diluted, came in at 55 cents. Operating income was $727 million, which gives them an operating margin of 13%. Cash flow from operations looked pretty solid, $896 million. And free cash flow was $582 million. They also bought back about $250 million worth of their stock in the quarter.
So, yeah, looking at it quickly, you see revenue inching up, decent cash coming in. But the really interesting part, I thought, was how different the market outlook CEO Jeff Miller laid out was. I mean, compared to just 3 months ago.
Oh, absolutely. It was a real shift. He pointed to, significant commodity market volatility in Q2.
Right.
Driven mostly by, the usual suspects lately. Trade and tariff nerves, geopolitical stuff flaring up, and OPEC plus bringing back those production cuts maybe faster than expected.
Yeah.
And all that led management to say pretty plainly, look, the oilfield services market is going to be softer than we thought over the short to medium term anyway.
That's quite a statement. What were the sort of specific things they saw that made them change their tune so much?
Well, a couple of key things. In North America, they mentioned multiple operators, and not just small ones, some big established customers too, are now planning meaningful schedule gaps for the back half of 2025.
Meaning empty calendars, basically.
Yeah, fewer jobs lined up. And then internationally, particularly with some big NOCs, the national oil companies and IOCs, they're seeing continued activity reductions and, less discretionary spending, which that's pretty typical when commodity prices dip. Plus, we all seen the headlines about reorganizations and cost cutting across the industry.
Okay, so the near term, maybe not looking quite as bright. How's Halliburton actually planning to handle this, and what's their longer view?
Right. So despite the immediate softness, management was clear they think the fundamental demand for oil and gas is still strong long term.
Okay.
They expect things to improve as that extra OPEC plus production gets absorbed. And, operators globally have to keep replacing declining output while demand still grows.
Makes sense.
But for right now, they're taking action. Big one. They said they will not work equipment if the returns aren't economic. That includes their frack fleets in North America.
So they'll park them?
Essentially, yes. Stack the fleets, as they say. They also plan to cut costs, both variable and fixed, over the next few quarters to right-size things. And they kept hammering home the focus on free cash flow and returns, being, careful with capital.
That returns focus is definitely a theme. So given that near-term caution, what are the big strategic plays they see shaping the next few years? Where are they betting?
Yeah, that's where you see their longer game. They laid out 3 key themes. First, unconventionals aren't going away. They see that remaining critical, pushing advanced tech for better recovery and returns, and expanding that globally.
Okay.
Second, production services, think intervention, stimulation, artificial lift. They see that growing as global production itself keeps ticking up.
Right, keeping existing wells flowing.
Exactly. And third, they anticipate more demand for complex drilling and well construction, needing, smarter tools, more automation for efficiency. Halliburton feels like they're lined up well with these trends to deliver strong returns.
That's a clear strategy. Let's break down the Q2 performance then. How did the actual divisions do? Completion and production, CMP, and drilling and evaluation, D&E.
Okay, so CMP revenue was $3.22 billion. That was up 2% sequentially, mostly thanks to seasonal upticks in pumping activity in the Western Hemisphere.
Right.
But operating income actually dipped 3% sequentially to $513 million. Margins landed at 16%. And that slip was mainly due to lower pricing for stimulation, so fracking in the U.S., plus less activity over in Saudi Arabia, especially in frack work there.
Okay. And drilling and evaluation, how did D&E look?
D&E revenue was $2.3 billion, also up 2% sequentially. That was driven by more drilling services activity globally. But yeah, operating income there dropped 11% sequentially to $312 million. Margins at 13%. And that was mostly because of the seasonal timing of software sales rolling off from Q1, plus higher costs for starting up new projects, mobilizing equipment and crews.
Gotcha. And geographically, how did North America stack up against the international side in Q2?
International revenue overall was up 2% sequentially. Europe, Africa did well, up 6%. Norway was strong there. Latin America was even better, up 9%, thanks to Mexico, Brazil, and more well work in Argentina.
Okay.
But Middle East Asia revenue actually fell 4% sequentially.
Yeah.
That was mainly the lower activity in Saudi and Kuwait we mentioned.
Right.
North America, meanwhile, was basically flat compared to Q1. Revenue was $2.3 billion. The usual seasonal boost in completions was kind of canceled out by lower service pricing and also less artificial lift business.
And they gave some Q3 guidance, too. What's the outlook for the current quarter?
Yeah, they did. For C&P, they see revenue down 1% to 3% sequentially and margins compressing by 150 to 200 basis points.
Yeah.
So 1.5% to 2% lower. Yeah. For D&E, they also see revenue down 1% to 3%, but they expect margins to actually improve by 125 to 175 basis points.
Interesting. Why the difference?
Well, the C&P margin pressure is mostly that North America pumping softness, fewer completion tool sales internationally, and that ongoing Saudi frack slowdown. For D&E, the margin lift comes from new software sales kicking in, better performance in global directional drilling, and just not having those Q2 mobilization costs hitting the books again.
Okay, that makes sense. Now, you mentioned technology before. It always seems central to Halliburton's pitch. What specific tech highlights stood out this time?
A few really cool things, actually. In North America, Chevron hit a milestone using Halliburton's Zeus IQ closed-loop fracturing system. That's their big automation play for fracking.
Right, the electric fleets.
Exactly. And Halliburton expects maybe a third of their Zeus E-fleets will be running with Zeus IQ by the end of this year, which is pretty fast uptake for tech that just launched last quarter. Then there's their iCruise and Logix automation for drilling. Apparently that's helping customers drill longer, more complex wells consistently, and it's driving double-digit revenue growth for them in North America drilling, even while the rig count is down.
Impressive.
And one more, EarthStar 3DX. It's a new logging while drilling tool that basically gives a 3D map of what's ahead of the drill bit. Allows for, proactive steering, much more precise well placement, like real-time underground GPS.
Very cool. And artificial lift, you said that was a bright spot internationally.
Oh, absolutely. That's becoming a really big growth engine for them outside the U.S. They just landed their biggest ever international ESP contract. That's electric submersible pumps from Middle East NOC.
Okay.
Middle East and Asia is their biggest and fastest growing region for lift. They expect international artificial lift revenue overall to grow over 20% this year.
20%?
Yeah. And they plan to double the installations of Intelvate, which is their remote monitoring and automation platform for lift systems.
But not so hot in the U.S. for lift.
Right. U.S. land artificial lift is soft, partly activity levels, but they specifically called out tariffs having a notable impact there. They expect tariffs overall to hit them for about $35 million or 4 cents a share in Q3, and artificial lift is the biggest piece of that.
Okay, interesting wrinkle. So this brings up the customer side. How are Halliburton's customers actually reacting to all this, especially those white spaces in the North American frack schedules?
Generally, customers are being cautious.
Yeah.
Watching their budgets closely. That's why you get the schedule gaps. But Halliburton says customers still consistently emphasize needing the best tech and top-tier service quality to get the most out of their wells.
Quality over quantity, maybe?
Sort of, yeah. Looking out to 2026, it's still pretty murky because of all the volatility. Management thinks activity will probably pick up earlier next year compared to how Q3 and Q4 2025 are looking now. But they don't see customers suddenly, doubling down unless something changes, like the price outlook improves significantly.
Right. And Halliburton's response is clear. No chasing bad deals. What does that actually mean on the ground for pricing and market share? Are they willing to lose share?
That seems to be the message. It's a strategic choice. They're willing to stack fleets, take equipment offline, and not work if the price isn't right, even if it means lower utilization or giving up some volume in the short term.
Have they done this before?
Yeah, they pointed out they did something similar in the U.S. gas market about a year ago when prices there tanked. Their logic is pretty clear. Working at unprofitable rates just destroys equipment faster, it increases safety risks, and it's just, bad business long term. So yeah, focus is on returns in North America, not chasing market share points.
Okay. International unconventionals kept coming up too. How big a deal is that for them, really? And where's the growth beyond the U.S.?
It's definitely meaningful. and very tech-focused. Argentina's Vaca Muerta shale play is a big one. Lots of customer investment there. They're seeing double-digit growth year over year in their frack business outside the U.S.
And beyond Argentina.
They mentioned Saudi Arabia, obviously, but also opportunities in Australia, the UAE. They've got work starting there in Q4 that they're billing as a showcase for Zeus IQ, and interestingly, most of North Africa.
Oh, North Africa. Okay.
And a key point they made, a lot of this international unconventional demand is being driven by the need for natural gas, not just oil.
Right. What about that huge Jafurah gas project tender in Saudi? Any updates?
They confirmed it's ongoing, but they sounded very disciplined about it, said their approach is all about long-term returns, not just winning volume. They acknowledge those kinds of massive tenders can get super competitive on price.
Sticking to their strategy. Any other hints about, say, selling off parts of the business, or did things like recent tax changes come up?
They say they're always looking at their portfolio, pruning bits that don't meet return hurdles and investing more in high growth areas like that ESP lift business. So yeah, they'll take a hard look at underperformers. As for tax reforms, like the big beautiful bill reference, they didn't think it was really driving customer decisions right now. Said those are still mostly about budgets and commodity prices.
Makes sense. Okay, cost and capital spending. What's the plan there with the market softening?
They're definitely pulling levers on variable costs, scaling down crews, supplies, maintenance as activity dips. On the structural side, the fixed costs, they're aiming for maybe 1% efficiency gains over the next couple of quarters as they resize.
And CapEx, still spending.
Full-year CapEx is guided to be about 6% of revenue. The Zeus E-fleet build-out, they stressed, is purely demand-driven. They only build them when they have a contract signed.
So if demand slows...
then the build-out slows. They said about half their fleet is Zeus already, so if new contracts don't materialize, they won't keep building speculatively.
And industry-wide, are we going to see more equipment just get scrapped?
They think so, yeah. They expect overall fleet attrition to speed up in this kind of market. Older pumps get retired, maybe cannibalized for spare parts. And they made an interesting point. Fracking for gas is generally harder on equipment than fracking for oil because the pressures are higher.
Oh, faster wear and tear.
Exactly.
Yeah.
Which kind of reinforces their decision not to work cheap. You burn through your assets even faster.
Okay, last big piece. Free cash flow and giving cash back to shareholders. What's the latest thinking there, given the revised outlook?
So with the market softening, they did trim their free cash flow forecast for 2025, now expecting between $1.8 billion and $2 billion.
Still a decent chunk of change.
Oh, yeah. And crucially, they said their commitment to shareholder returns is unchanged. They still expect to return more than 50% of free cash flow this year, once you factor in the dividend for the second half. They plan to keep up the current pace of buybacks and dividends. It signals confidence, even with the headwinds.
All right, we have really covered a lot of ground here, unpacked the numbers, the strategy shifts. Now, let's switch gears a bit. Time for our not financial advice segment. Remember, everyone, this is purely hypothetical. Do your own research, consult professionals, all that. But if you had to pitch one, let's say outrageous but plausible trade idea based only on what we heard on this call, what would it be?
Okay, outrageous but plausible. Given Halliburton's really strong stance on not working cheap in North America, their capital discipline, but also those powerful international growth spots like artificial lift and global unconventionals. Here's a thought.
Lay it on us.
How about going long Halliburton? So buying HAL stock, but pairing it with a short position, betting against a smaller, maybe pure play North American pressure pumping company, one that doesn't have Halliburton's tech edge or global reach.
Okay, interesting. What's the logic?
The logic is this. North America's got headwinds, right? Halliburton is choosing to step back from the lowest margin work, protect its equipment and profitability for the rebound. Meanwhile, its international side, especially the high-tech bits, looks set for really strong growth, double digits potentially.
Right.
The smaller, maybe less disciplined competitor, stuck in that soft North American market, they might feel forced to chase volume, take those low-margin jobs just to keep busy. That can mean burning through their equipment faster, crushing their margins, and they don't have those international growth engines to fall back on.
So it's a bet on discipline and diversification winning out over just trying to stay busy locally.
Exactly. A bet that strategic patience and global tech-driven growth will outperform chasing volume in a tough domestic market. Plausible? Maybe. Outrageous? A little. Definitely not advice.
Haha. Definitely noted. So wrapping this all up, Halliburton's Q2 call really painted a picture of a market in flux. You've got this near-term softness, but they're holding on to a strong long-term view for oil and gas demand, and they seem very clear on how they plan to navigate the bumps.
Absolutely. I think the core takeaways are, one, technology is absolutely central to their differentiation strategy. Two, they are serious about capital discipline and prioritizing returns, even if it means parking equipment for a while. And three, those international growth areas like lift and unconventionals are performing really well and are key to their story. They definitely project confidence in delivering value through the cycles.
And just one more time for everyone listening. The discussion here, especially that trade idea, is purely for educational and informational purposes. It's absolutely not financial advice and shouldn't be seen as a recommendation to buy or sell anything.
Please, always do your own homework and consider your own financial situation, maybe talk to an advisor. But, it does leave you with something to think about. In this kind of volatile market, how do companies like Halliburton, the ones prioritizing long-term returns and maybe sacrificing some short-term volume, potentially change the whole competitive dynamic? How does that play out?
Definitely something to chew on. Thanks for joining us for this deep dive today. We'll catch you next time.